Welcome to Allianz Global's Investors Webinar Series. Today, we have Cheng, our Portfolio Manager of European Equity Dividend, who will provide us with an update. My name is Charles Ma, and I'm your host for this webinar. Despite the heightened market volatility year to date, we have seen renewed interest in our European equity dividend funds. Perhaps it is due to the rotation from growth name to value names. And today, we are happy to have Grant Cheng to give us an update on the European markets. Grant has over 25 years of investment experience and is deeply involved in the investment process of our dividends and value strategies at Allianz Global Investors. On that note, Grant, the floor is yours.
Hi, good afternoon, everyone. My presentation will consist on the market outlook, and I'll explain why we believe Europe can perform better than other regions, and in particular, why we believe the dividend and value styles have a chance to do better going forwards. And second point, I will touch upon our investment philosophy, which I feel is also very important for you and to take with you. So let's go to the market outlook first of all, and here on this page. I think here are some of the key messages. And first of all, we believe that European markets are more attractive than a lot of other regions in the world, and both in terms of valuation, earnings momentum, and of course, the level of dividend yields. And we shouldn't forget, and by the way, and especially compared to the US market, the European market is very much under-owned by a lot of investors. And besides, as we know, that in simple terms, if you look at the balance between growth and also value styles or growth versus other income styles, and Europe is more balanced. And I'll explain that as well. And that's why we believe in a world where there is more correction of some of the value styles due to overvaluation, not everything, of course, and then a more balanced region, and also in terms of the stocks that one can own in Europe and on the income and dividend side will have a better chance to perform. Apart from attractive valuation, earnings, and one thing I also want to mention and is the kind of fiscal support we continue to get in Europe. Europe is somewhat late in the recovery stage compared to China, compared to the US, but now Europe's recovery is well underway, and hence Europe also benefits from that, and plus the huge fiscal support we'll get. The next one is about the political landscape, and I think this is probably on the mindset of everyone, and given what is currently unfolding in Europe. I will leave it very brief here. So let's come to the COVID situation, clearly also on the mindset of everyone. We know that we are still in the middle of the pandemic, like everywhere else in the world, and you may hear reports of high levels of infections, a number of cases in Europe. And two things I want to mention. And first of all is that in most or in a lot of countries, and including here in Germany, where I sit currently, we have reached a plateau, or the number of cases tend to decline over the past couple of weeks. And the second thing is the Omicron wave currently somewhat shocking if you look at the number of cases, but the economy has shown a very good resilience. Due to the past experience we have already had in dealing with the virus over the past 2 years, and more importantly, I think it's also helped by the high level of vaccination rates amongst the population. So that has helped our economy more resilient, and we see so far very little impact as a result of the current Omicron wave. I touched upon the economic package Europe has. And here's just an example to show the kind of firepower that EU has, and especially on the new economy side and the new energy initiative that Europe has. And here is an example of 800 billion euros of package. And the disbursements of the money started already last year. It will continue this year and also into next year in supporting the various European countries moving towards more green and also digital economy. And this is an example, as I mentioned, and it shows clearly the commitment that the EU has and also the fiscal capability EU has to support the economy. Let's come to the capital markets. And I think one important reason why we say Europe has a better chance to perform and versus, for example, the US market is a huge valuation gap. European equities have obviously become much more attractive than the US equities. And here I take with you an example of the price to earnings ratios between Europe and US, and on a cyclically adjusted basis. And you can see clearly that there is a gap between the valuation, in particular after the global financial crisis 2008, between the European equities and the US equities. And this gap continued to widen. And one question a lot of people may have, and why we have such a wider gap. And I just want to look, and also from the components perspective, and as an example, clearly we know that US market is very much driven by the technology sector, and this widening gap and of the valuation and the tech component played a quite big role. And if you can see from this slide, and US derives almost 40% of its total market PE valuation from technology, whereas Europe's components are much more balanced. Therefore, in a world where we are concerned about the overvaluation of the technology sector, especially those so-called long-duration assets, the impact on European equities are much limited than the US. And we can look at it also from another angle, and here's in the next slide. And if we look at the geographical distribution of the revenues from companies both in the Europe, in US, Japan, and Asia Pac, and clearly you can see the European companies are true global champions. And we generate revenues from very diversified geographical sources, and hence this is also a very, you can say, important buffer and a protection at times of uncertainty. And also, it also allows European companies to benefit more from the post-COVID recovery in various parts of the world. This is also very important to remember if we talk about the features of the companies. We have more global companies in Europe. Now, let's come to the second point in this part is about the valuation, not only between Europe and US and Europe versus the rest of the world, is the style differences. Charles touched upon that. And here is also a very good example. Clearly, we know that the huge valuation discrepancy between Europe and US, and also in particularly the technology sector, is one of the contributors to this discrepancy. But also it's reflected in terms of the investment styles and also the huge performance difference between growth and value in the recent years. That has resulted in a huge, you can say, crocodile jaw. And for us, you can see the relative performance of the growth and the value here. And for us, it's the key message here is it's not a question of if, it's just a question of when this jaw will snap back. And actually, it's already happening, as you can see from the market actions in the first months of this year. And actually, for us, this correction is long overdue, and we believe it will continue. And especially, this is triggered, and it will continue to be triggered by rising inflation expectations and also the policy response from the central banks. And you saw the decisions in the Fed. You saw also the change of stance at the European Central Bank towards the rates, and hence the rate expectations are clearly on the rise. And this will lead to further, you can say, closure of the gap between the growth and the value and income styles. Now, we are dividend investors, and hence it's important to talk about dividends. 2020 was not an easy year for dividend investing because during the outbreak or onset of the pandemic, And a lot of companies, actually no exception in Europe, everywhere else in the world, but in Europe in particular, a lot of companies had to cut their dividends, to suspend their dividends for the sake of protecting their balance sheets, which we believe is actually a reasonable thing to do for more actually income generation for the future. And secondly, a lot of companies had to do that due to regulatory requirements. That is in particular in the case, let's say, in the field of banks and also in some of the financial companies, insurance companies. And 2021, and with the recovery of the economy and with the recovery of the earnings, we clearly saw the recovery of the dividends, as you can see from this chart. And the banks also started to resume their dividend payments, and insurance companies as well, and a lot of industrial companies on the back of stronger earnings even started to pay more dividends. And we believe with the continuing economic recovery in Europe into 2022, and this dividend normalization is continuing. So let's go to the next one and talking about the industries which have had the most earnings recovery. And it's important to note that a lot of cyclical and value income sectors, such as base materials, automobiles, they continue to have prospects of good earnings improvements. And these are the company paying good dividends, as we can see, and we've been actually collecting a lot of income and dividends from these sectors. And it's also important to note that here's an indication, by the way, of how the street analysts are revising up their earnings estimates. And clearly you can see the companies in the sectors like base materials, automobiles, energy, they continue to have very good earnings upward revision. And so this is very good, and also for the beneficiary of income, dividend, and value investing. In conclusion, investing in Europe, and in particular in value and the dividend stocks, is the right place to be for 2022. Now, let's go to the next part, and let's talk about our investment philosophy very briefly. I suppose that a lot of you know our investment philosophy. There are three hallmarks of our dividend investing, I think, which is very important. I think it's very important to mention that because we use dividend yield as an absolute hurdle for decision making, being using it for purchasing stocks and also using it for reducing or selling stocks, and hence we would tend to own the cheaper parts of the market. However, it's also important to mention, and because people would tend to think, oh, you own the easy or the cheaper part of the market, and what about the quality of those companies you own? Quality is also a very important part of our analysis, and it's important for us to stress that when we look at dividend stocks, when we do own cheaper parts of the market, we do not sacrifice on quality. Quality, what we mean by quality in particular, and what is in particular relevant for dividend investing, is a very good understanding of the viability of the company's earnings model and their business model, and hence to judge their capability and also the willingness to pay dividends. And so if I can stress it once again, yes, dividend yield is a very important, you can say, guardrail for us, and also a very important signal for us. And what we mean by that is, first of all, as you know, is a dividend stock by the definition of the dividend yield it owns. And at the second point, I think it's also very important for us why we mean it's a guardrail and also a signal for investment. When dividend yields go up for a company, let's say a good company based on analysis, usually it tends to be the valuation gets cheaper. That's why it provides with a signal to buy into the stock. But on the other hand, even if it's a good company, but if the dividend yield becomes lower, what usually happens is that people are paying a very high multiple for a good business, admittedly, but then it's a signal for us it's getting too expensive. Usually that's the moment also for us to think about exiting from this position. So that's why we call it, and also if I want to explain this again, and why we would tend to end in the cheaper parts of the market. Okay, so let me just go maybe to the final page. As I mentioned, Europe is a more interesting asset class for this year, and we believe that Europe has a good prospect to outperform other regions and this year. And in particular, in the environment of rising rate expectations, value and dividend investing will benefit from that. Maybe one last word before I conclude. We know that markets can go up, markets can go down, markets can end in huge plus, markets can end also in huge minus. But dividend is always here to stay. And traditionally, dividend has played a very important role as a stable source of income. But this role has got somewhat diminished over the past couple of years as people chased highly valued growth stocks. And now we believe it's a time that this is about to reverse. And dividend will continue to resume its traditional role of income generation as an important source of income. And hence, that's why we believe dividend investing will gain its traditional importance. Thanks.
Allianz Global Investors.